After going through a sizable drawback in share price over the past 6 weeks, a high-quality income stock is now offering a dividend yield of close to 11%. And I've recently taken the chance to pick up more shares of this holding to get an even greater bang for my investment buck. The company I'm referring to is Blue Owl Capital Corporation, ticker OBDC, and I recently bought an additional 51 shares of this stock. Since their IPO, this BDC has been a really solid holding and has outperformed a lot of their peers within this sector. In this video, we'll take a look at this company since it's been a while since we've done a check-in on Blue Owl, and we'll see exactly how it's been outperforming a lot of their peers. Blue Owl Capital Corporation describes itself as a specialty finance company and a business development company that provides direct lending solutions to U.S. middle-market companies. Their portfolio consists of predominantly senior secured loans that are directly originated by Blue Owl's credit team of investment professionals. The company also makes investments in unsecured loans, subordinated loans, or mezzanine loans, and they also consider equity-related securities. This BDC was launched in 2019, so it's not nearly as old as other companies in this sector. But despite being a newer company, Blue Owl is already the second largest BDC in the sector. This company has a current market cap of over $6 billion according to Stock Analysis. That is a lot, but it's still only half of the market cap of the largest BDC, Ares Capital. Let's start by taking a look at this company's most recent financial results. In Q1 2024, the company earned 47 cents per share of net investment income. That same quarter, the company issued a regular 37-cent per share dividend and a special dividend of 5 cents per share. So as of the making of this video, OBDC has a dividend payout ratio of just 78.7% without taking the special dividend into consideration. This is very comfortable for a business development company, which normally have higher payout ratios. It's not uncommon to see these stocks have payout ratios in the high 80s to 90s. They also announced their net asset value per share had grown to $15.47 compared to $15.45 in the previous quarter. Net asset value represents the total value of a BDC's investment portfolio, so it's always good to see this metric go up for a company over time or at least remain flat. The issue that BDCs face is that they're required to pay out 90% of their earnings to shareholders in the form of dividends. Because of this, it doesn't leave much left over for the BDC to grow their portfolio based upon their net interest income too much. It's actually somewhat rare to see these companies consistently grow their NAVs by huge amounts on a regular basis. If we look at OBDC's NAV per share over time, this company has been a pretty solid performer when it comes to picking good investments. It's not exactly visible by looking at this bar chart, but Blue Owl has grown their NAV every quarter for the past 2 years, which is a good sign. Another great aspect of this stock is its dividend history. At no point has this stock ever gone through a dividend cut. It looks like it has according to Seeking Alpha's information, but you can see that for some reason they actually stacked the special dividends they paid along with their regular dividend in these quarters. They were originally paying 31 cents per share when they first launched, whereas now they pay 37 cents. Blue Owl has also paid special dividends in the majority of their quarters. You can see their latest special dividend was for a bit less compared to their fourth quarter in 2023. They could have afforded to pay the same special dividend they paid in the previous quarter instead of the 5 cents we got. But I'm suspecting that they're starting to slowly reduce their special dividends because they anticipate interest rates being cut. This is another aspect of Blue Owl and a lot of good other business development companies that exist. BDCs that hold a large percentage of floating rate investments in their portfolios have been enjoying a large influx of additional income from their debt investments over the past couple years. Floating rate debt is when the interest payments the borrower has to pay are in part determined by the federal funds rate. When rates rise, then borrowers have to pay the BDC more interest. We've seen a handful of BDCs pay a lot of special dividends, and Blue Owl is a company that's paid a pretty good amount. However, when interest rates do get cut, then I would expect a lot of the special dividends that these BDCs have been paying to start drying up. But this also depends on how quickly interest rates get cut. If the Federal Reserve is very slow when it comes to cutting interest rates, then it's possible we could continue to see these special dividends stick around. Taking a closer look at their portfolio, roughly 73% of their investments are in first lien debt and 8% are in second lien debt. It hasn't changed too much over time, but it looks like they are slowly making more equity investments. First and second lien debt is the safest kind of debt that exists, although it's obviously not risk-free. Common equity investments don't typically pay interest, but it can potentially result in better growth in their NAV for a BDC. Main Street Capital, for example, is a BDC that holds a lot more common equity investments. Although it is the lowest yielding BDC in the sector, it's offered some of the best growth out there. So it's possible that Blue Owl might be trying to offer investors better share price growth, assuming their common equity investments do well. However, it doesn't necessarily mean that this company is changing its investment strategy. It could just be that Blue Owl has recently come across some better equity investment opportunities over the past few quarters. According to their website, it also says they don't normally invest in cyclical companies. So unlike some BDCs, they don't invest in oil companies, hotels, or aviation businesses. You can see their largest sectors would include software, insurance, and food and beverage companies. As of the making of this video, they have investments in 198 different companies across 31 industries. Some people have asked me if I know the reason why OBDC has been going through such a large sell-off. Since May 31st, their stock has fallen roughly 8.3% in share price. And I haven't found a conclusive reason as to why this stock has fallen so hard in share price in less than 2 months. I haven't seen or heard any negative news reports regarding their business. There could be a whole host of reasons why a stock goes down in share price. It could be that a bank or a research firm downgraded their stock. It could be the result of insiders selling a bunch of shares or a large institution unloading shares from an investment fund. But what I think is likely the reason it's continued to fall in share price is the fact that it was pretty overvalued back in late May. On May 31st, their stock was trading at $16.86 per share, which meant that their stock was trading at a pretty sizable premium. It's possible that after the impressive run-up in share price that some investors wanted to capitalize on their gains they received and they wanted to get out. From what I've gathered, I don't see any concerning evidence that this company is in any kind of trouble. Their non-accruals, which are the percentage of investments that they aren't receiving interest on, did increase a little bit to now 1.8%. But this number is still lower than the industry average and is almost identical to Ares' percentage of non-accruals. But as I've said in the past, whenever good stocks go down in share price, that's always good news for long-term investors, but it's especially good news for income investors. If you invest $200 in a stock that just fell 8%, you're going to collect more dividends, and if it's your goal to someday live off dividends, you're now going to achieve that goal faster. I've also been asked what I think about Blue Owl's other BDC, which they launched about 6 months ago. Interestingly, the same company came out with a different BDC, and if you want to know what the name is, it's called Blue Owl Capital Corporation 3. What happened to Blue Owl Capital Corporation 2? It turns out that it's a non-publicly traded BDC that you can only invest in if you work through a financial advisor and if you're willing to put up a very large initial investment. I've never gone for any of these non-traded BDCs, REITs, or MLPs as they have a number of disadvantages. But their new public BDC, which trades under the ticker symbol OBDE, is pretty similar with really only one major difference. OBDE is more defensive in what they invest in. They're only about 1/6 of the size of OBDC, and yet they're invested in almost as many companies and sectors as OBDC. So with the same company involved, this might be a good alternative to consider if you are a more risk-averse investor. The downside is that it does offer a lower yield, which is a little over 9% compared to 11% for the other BDC. So in summary, while it may not be clear why OBDC has been falling in share price so much over the past 6 weeks or so, it definitely now offers a much more attractive dividend yield. Its defensive portfolio, along with its great dividend track record and net asset value growth, make it a good consideration for any investor seeking income. Let me know your thoughts and if you hold any shares of this company. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.